Well, good afternoon, everyone. My name is Bill Fox. Welcome to this quarter's Beyond the Noise. Our goal at the Fox Alliance is to offer insights into big economic themes. Our topic for today is Beyond the Hype, how to invest wisely in a world of innovation. Today, we'll start off discussing some background behind innovation. We'll then talk about how innovation will affect education, healthcare, law, transportation, and entertainment. We will then do a review of what happened during the dot-com era. We will finish up with principles for innovation investing. Our panelists will speak for about 30 minutes, and we'll have time for questions after that. As before, compliance doesn't allow us to use the chat feature. So if you would like to ask questions for the end, please email me at bill@thefoxalliance.com. Our presenters today will be Max Clark and Laura Cooper, two of our financial advisors, and Josh Renfro, who is our Chief Investment Officer. Max will be our first presenter. Max, if you could take it away.
Thanks, Bill. I appreciate it. As Bill said, we're going to kick things off by taking a look at innovation and kind of the history of what's led to where we are today, and look at some of the cool things that are being done with AI. You know, when we think about AI, at least for me, it feels like things have really begun to take off just recently, like in the last year or two. But the reality is the foundations for AI have been in the works for 60, 70 years, to be truthful. And I think this quote by Ray Kroc, the McDonald's CEO that really made McDonald's famous, is appropriate for AI. I was an overnight success, all right, but 30 years is a long, long night. And I think that demonstrates really what has happened with AI. If you look here at kind of this timeline, looking back historically, AI has been in the works for over 70 years. Looking back to kind of the late 40s, that's when we saw the first digital computers come into play. And right there in 1950, there was something called Theseus, a small robotic mouse that could navigate a simple maze and remember its course. Move forward to the early 90s, you guys may remember something called TD Gammon. And this was a software that learned to play backgammon at a high level, just below top human players. And so we've really seen things building this foundation for some time. But what's occurred recently is we've seen kind of exponential growth in the capabilities of AI. So what this chart shows is looking back to basically 1998, the various types of comprehension or recognition that AI technologies have achieved. So you can see back in 2000, handwriting recognition and speech recognition was relatively low. The line across the top here at 0 represents human performance, basically as the benchmark. Anything below this is AI systems perform worse than humans, and anything above that, AI systems perform better than humans. So handwriting, speech recognition, image recognition, reading comprehension, and language understanding, it's really in the last 3 or 4 years, 4 or 5 years, that we've started to see these all get not only to the level of humans, but exceed humans by a significant margin. And I think this really speaks to some of the explosion that we've seen, or what feels like an overnight success, is that we're really starting to see AI achieve the almost sci-fi-like results that we've only dreamed about. And I'm going to show you a couple of examples here. Take a look at AI generation. This is probably the biggest thing that we've been seeing come onto the scene over the last year or so, and it's called generative AI, which is artificial intelligence generating either images or texts or videos, whatever it may be. And take a look at the progression that we've seen over the last 10 years. So to remind you guys, these pictures and images aren't real. These aren't real people. This is generated by the computer, the artificial intelligence. And looking back to 2014, you can see that it really wasn't that great. We had a blurry image of a woman, not particularly recognizable. But you can see that over the next 3 or 4 years, it got pretty good. And it's only improved from this point. Let's take a look at some of the things that have been generated just this year. This is not a real person. Some may say it looks a little too real or a little too saturated or pretty to actually be real. But this is really high quality AI generation. This is what is this is the capability of these tools. Here's another example of that. I mean, it's hard for me to imagine this not actually being real. And one more, this is basically a look at somebody from India, I believe, who, at different ages in their life, kind of the same person. And these are pictures that I would think could be in National Geographic or something like that. I mean, this is really high quality AI generation. And these are the types of tools that we're seeing not only come onto the scene, but improve significantly each and every day. Another thing that's really impressed me and impressed really the tech scene recently has been text to video. So basically AI generation of video. You can type in, hey, I'd like to see this, and you see video created. I want to show you an example of that. Here's an AI video that was generated of, I think the prompt was something along the lines of, hey, we'd like to see golden retriever puppies playing in the snow. And take a look at the quality of this video. I mean, it's hard for me to imagine this not being real. I mean, this looks like somebody's taken a high quality HD video of 3 little puppies playing in the snow. And this is the type of technology that we're seeing today. And this is why I think people are saying, hey, we've made real breakthroughs. It's because we're starting to see some of the dreams that people have had for many, many years coming to the forefront. So the real question that we need to ask ourselves now is what's next? I mean, what could we see happen over the next 3 or 4 years? Now that we've kind of made these initial breakthroughs, we're starting to see exponential improvements of these technologies. And it's going to impact, truthfully, over the next 10, 20 years, every area of life. But I just want to look at a couple of examples here. Think about education. I really believe that over the next 5 to 10 years, education could probably be unrecognizable. I mean, I think AI will likely transform that space. Students are going to be receiving customized curriculum designed specifically for them and probably tailored to their learning styles. Truthfully, by the next 5 years, it's probably not going to look anything like it is today. What about healthcare? Well, I think with healthcare, I think AI is going to become a standard tool for doctors, physicians' assistants to use in the process of diagnosis. I think it's already starting to to be used in that respect, and probably will continue to be, and just that technology will continue to improve. That's likely to lead to more accurate and faster diagnoses, allowing us to treat these diseases more quickly and more effectively, leading to better quality of life and longevity. So I think that's going to be a real positive. What about law? We're already seeing law be pretty heavily impacted by technology. I mean, there are chatbots out there right now where they'll give rudimentary summaries of law and draft some legal language. But I think over the coming years, it would not be unreasonable for us to expect to see 2 or 3 lawyers with the assistance of AI tools be able to do the work that 20 to 25 lawyers used to be able to do. So I think we're going to see much greater efficiency, cost savings in that space. And I think that's going to change that space pretty significantly. I think one of the areas that is really sci-fi in my mind is transportation. It's probably where we're going to see kind of the real physical outworking of AI most significantly recently. You guys may have heard that Tesla and Elon Musk recently announced their continued work on robotaxis. And there are actually places like San Francisco where you can go, and it's not Tesla necessarily, but other companies are currently, you can get on a car that has no driver in the front seat, and it will drive you to where you want to go. And that is already here, and I anticipate that changing significantly going forward. And we'll probably see this with the vehicles that drive us to work, trucks, and the trucking that occurs across country. a lot of that being done by AI. Autonomous vehicles in space, those sorts of things. I've already seen some of that, but I think we'll see more and more of that play out. So transportation, I think, is going to be a really transformative area. And I could see that transform significantly in just the next 5 to 10 years. The last area that I'll point out is entertainment. I think it's an area that's really exciting to think about. I mean, historically, entertainment, songs, movies, those sorts of things have taken years and years to develop, to write. There's a lot of artistry involved in that. And I think a lot of that will still remain. But I think going forward, the entertainment world could transform significantly. Where imagine sitting down one evening with your wife or with your family and say to the AI system, hey, we want to watch a movie about X, Y, or Z that has, it's a thriller and whatever it may be. And it generates the movie that's never before been seen specifically for your taste. And it's really high quality and exactly what you want it to be. I think that is likely an outcome that we see in entertainment. So the key thing to note here is we are at a real new innovation era. I think the last one that we saw was probably the internet. When the internet came on the scene and transformed life, a lot of people are suggesting that this is the next internet and it could transform things going forward. And that's why we're having this conversation. So I'm going to turn it over to Laura to talk about kind of what occurred in the investing world back when we saw the internet come on the scene, and start talking about some of those lessons that we can learn from that and how we can apply that to today's world. Laura?
Perfect. Thank you so much, Max. As Max mentioned, artificial intelligence is expected to become the greatest technological innovation since the internet. And one of the biggest questions is, how do we invest into that space, knowing what happened with the internet? So I'm going to take a walk through memory lane and talk about the dot-com bubble or the tech bubble, what led to it, and what the pop actually looked like. So between 1995 and 2000, the NASDAQ index rose 5x, which is not normal. That's not a normal expected return over a 5-year period, just to be clear for all of our clients out there. But 5 times returns, over 500% returns in 5 years just goes to show you how much euphoria and mania there was around a lot of these tech companies. And when we really look under the hood of what the internet or what the investment landscape looked like, in 1999, 39% of all venture capital investments were for internet companies. 457 IPOs, or 457 companies IPO'd in 99, most of them related to internet companies. And here's the thing that I think is most important. The PE ratio, the price to earnings ratio of the NASDAQ in 99 was 100. The average PE ratio of the NASDAQ index is 28. So prices, if you really look at that, prices were about 4 times higher than average earnings. That just goes to show you just how much people were willing to pay for companies that in a lot of cases didn't have any earnings, barely had any revenue, barely were a company in general. They might have been what we'd refer to now as a startup that happened to go public, and it was more like 2 people in their garage with an idea. Some of those ideas were great ideas that we actually came about today in the form of companies, internet companies, but at the time, they didn't have the necessary growth. So as I mentioned, 579% growth in the index from 1999 to 2000. And what I think is extremely interesting is we then saw a 77% decline over the next 12 to 24 months. So 5 years, 500%, 77% decline over 2 years. If you had bought in 1995 and held your investment all the way through, so from 1995 to 2000, the end of 2002, you would have had about the same amount of money from the beginning of that time period to the end. But what most people did during that time, and what most people do in the time of euphoria and mania and craze when it comes to a specific market is they don't buy in at the beginning. They buy in 98 or 99, or in a lot of cases, they buy in 2000. And so they experience a significant decline. Their experience in that investment market is not ideal. So what I also think is really interesting, though, is that there's this idea that if you buy a blue chip company, you're safe from very large drops. And when one of the characteristics of bubbles is that it takes everybody out. There were a lot of companies that did go bankrupt. Their stock prices went from 100 to 0 in a 2-year period. But there were also companies like Cisco, Intel, and Oracle, which have been some of the most revolutionary companies, American companies of our lifetime, that dropped 80% during the dot-com bubble. So it's really important to, again, remember, just because you might have a big name, you might be the biggest player on the street at the time, bubbles do not discriminate on who loses money in that craze. It took 15 years for the NASDAQ index to regain its peak, which it did in April of 2015. So again, very important to remember when we have these really big mania craze rises, they usually end in large falls that then take quite a long time to recover. So let's talk about principles for innovation investing. If we don't want to go back to the time to the dot-com bubble and we want to be smart about how we invest, here's 5 principles that we think are important. The first is to seek to identify monopolies versus commodities in the long term. So monopolies are companies that hold a majority market share in their industry, and it could be a duopoly, which is 2 companies, or an oligopoly, which is a handful of companies. 2 really important characteristics of a monopoly is, 1, there are very high barriers to entry. So there's not a lot of competition, and it's not easy for competition to enter the market. Really good examples of oligopolies here in the United States. The cruise line industry is one of them. The airline industry is one of them. One of the examples of a true monopoly is the diamond industry. So we're talking, and one of the characteristics of that is that those companies are what are called price setters. So they set the price of the good. We as a consumer take that price. It is not based on the true laws of supply and demand. In a commodity market, that is the opposite. Typically, a company that is a commodity or engages in or sells commodities, there's a low barrier to entry, meaning that competition can easily enter into the market. And what happens, typically profits are competed away. You become what's called a price taker. You take the price that the consumer is willing to pay based on the laws of supply and demand. So when we think about innovation and investing, you want to understand what's the difference between a monopolistic versus a commodity environment. And you really want to take a look at those companies that have the ability to set prices and to be the behemoth in their industry. Those are the ones that are going to have the longest longevity. So with that, I'm going to turn it over to Josh to touch on the last 4 principles.
Thanks, Laura. Appreciate that. So a couple of other principles that we're going to touch on. The first of which is it's important to understand, what does the pace of innovation typically look like? It's easy to get excited about the innovation that's happening and to not really understand exactly at what pace it's going to go. And I think this quote from Roy Amara really states it well, which is, we tend to overestimate the effect of technology in the short run and underestimate the effect of it in the long run. If you go back to the dot-com era and you were to look at some of the companies that did go bankrupt that Laura mentioned and alluded to earlier, a large number of those businesses, the ideas were not bad. They were just early. Either 1, the companies weren't really able, the technology of the time wasn't really capable of executing them, or the change that they were requesting of consumers was just too extreme in too short of a period of time. Great example, grocery delivery. There were grocery delivery companies that were started during 2002. They did not take off. And in that case, it was a combination of both. The technology wasn't ready as well as the consumer wasn't ready. So just because an idea is good does not mean that it will be executed on well or that that idea is investable. And I think that's a really important thing just to keep in mind. The third thing that it's important to think about is this: price matters, and it matters a lot. And so, and when I talk about price, I'm not talking about necessarily a share price. A good example of this would be Amazon versus Microsoft. Microsoft has a higher technical dollar price than Amazon has right now. The question is, what value am I actually paying for? And so probably the most common metric to measure that in is price to earnings ratio, which if you look here, we have a little formula here. You take the share price, you divide it by the earnings per share, and that's where you get the PE ratio. So in the case of Microsoft and Amazon, you'll see that while the share price for Microsoft is higher, the price to earnings ratio is actually lower at almost 37 versus in the case of Amazon, it's almost at 61. So just to translate, what does that actually mean? Let's say as an example, you retire and you were going to go buy a Starbucks that generated $100,000 of profits, or that's another word for earnings. If someone was willing to sell it to you for 3 times profit, you could buy that Starbucks for $300,000. Okay, so the price to earnings ratio would be 3. In this case, as we're talking about Amazon and Microsoft, that's the equivalent of buying that same Starbucks for 3.7 million in the case of Microsoft, or in the case of Amazon, for $6.1 million. So those are some high ratios, but these are also companies that grow a lot. And so we would expect that you would pay higher multiples. But this goes to show you, when Laura mentioned the 100 PE ratio that we saw in the NASDAQ in 2000, how absolutely absurd that was. People were willing to pay, what, 100 times $100,000 to purchase that Starbucks. That means you would have to hold it for 100 years before the profits, as they are stated today, would pay back your original purchase price. So price does matter. And that was one of the things that people lost sight of in the midst of the dot-com bubble. People were paying astronomical prices, in some cases for good businesses, in some cases for absolutely horrible businesses. But in either case, it didn't matter. Even if it was for a good business, oftentimes the result was substantial losses, because we still have to pay attention to what is the price that we are paying, even if it is for a really good investment. We also have to consider idiosyncratic risk. When Laura mentioned earlier, it's important to invest in monopolies. What she means is you want to invest in areas where it's likely that the company that you're looking to invest in has the potential of becoming a large, dominant player and taking over a large share of a particular market. In our opinion, if you look back at the dot-com bubble, a good example of a monopolistic area of the internet search, of the internet bubble, was internet search. Who was ultimately going to become the largest player? Because the reality is this: are people likely to go to multiple different internet search engines? The answer was no. And that was proven by the fact that today Google has risen to become 93% of all internet searches everywhere. It's a network effect. The more people who use it, the more valuable it ultimately ends up becoming. Back then, Google wasn't the only one. And some of these names you guys will recognize: Yahoo, WebCrawler, Ask Jeeves, Hotbot, Excite, Lycos. And of course, as we all know, almost none of these are still here today. Yahoo really is probably the main one. And the reality is, of the ones that existed back then, the overwhelming majority of them went to zero. That is called idiosyncratic risk. You may have been smart enough to determine, hey, internet search will become a multi-trillion, or let's say a multi-billion-dollar business. But if you picked the wrong player, the result could still have been an investment that literally went to zero. So idiosyncratic risk is an important thing to consider when you are thinking about innovation type investing. Being on the right horse, and this is the fifth principle, being on the right horse is more important than being early. Back then, if you were trying to determine between 1995 and even like 2000 to 2002 who was going to win the internet search wars, it would have been challenging to know. You might have had a good guess. There are plenty of smart people that guessed wrong. If you look at Google's stock since it went public in the mid to late 2004s, the amount of upside has been tremendous. And this illustrates a really important point in our mind, which is it's really important to pick the winner, even if you have to pick the winner later. And so, as I'm trying to just kind of summarize all these principles together, I want to leave you with a few words of caution. In the midst of all the exciting things that are happening right now, it's tempting to say, what can we do to take advantage of this trend right now? And I would caution individuals from diving in. One of the reasons is right now, I don't think we can even answer the question, what is the monopolistic areas that we could be trying to take advantage of within the artificial intelligence area? The most common area that people think about right now are the LLMs, the large language models, the Chat GPT, the Meta's open source tool that are coming out right now. And the challenge is most of the experts that we listen to and hear from on a regular basis agree that that is not going to be an area, or most likely will not be an area where we see monopolistic potential. In fact, the fact that Meta has just recently chosen to open source its large language models almost goes scorched earth on the entire concept of making it a profit center for most companies. It will most likely become an entirely free service. I know, many of you may pay for Chat GPT right now. And my suspicion is that over time, that will probably, if it does remain a paid service at all, the price will get driven down and will be competed away. The real question today is, what even are the monopolistic areas that we want to, that a good investor would want to focus on? And right now, there's a lot of debate about what even are those areas. So that would be the first thing that we'd want to even see is what is the defined areas that could have monopolistic or duopolistic like profits that are out there. And then even once that's the case, it is still really important to make sure that we see who is likely to win, because risk is still a very important consideration when you're making innovation like types of investments. The last thing that I would just say is it's important to be patient with these kinds of investments. The reality is, while we've seen a lot of change in a short period of time, it feels like every couple of weeks or every couple of months, new things are being developed and approved. It's so easy to be caught up in the manic optimism. And there's good reasons to be optimistic. But once again, going back to that second principle, oftentimes a lot of these changes take longer to occur than people expect. Even a lot of the things that Max mentioned, we're making educated guesses surrounding how long we think some of these things will take to really become effective in the market. Like as an example, the specific one that comes to mind is the one surrounding media and entertainment. I think what Max describes is a very viable option at some point in the future, but it is difficult to know how likely that is and exactly when that will ultimately end up coming about. And I would say that there's one last thing and I'll wrap up with this. One big challenge that a lot of people aren't talking about is one of the biggest challenges that AI is likely to face is the massive strain on our energy infrastructure that it poses. We've already seen projections that data centers are likely to go from 6 to 8% of the United States' electric demand, and is likely to grow to 18 to 19% over the next couple of years. And that's with where things are currently. Our grid is not prepared for this massive influx of a new demand system. And so that is one area we're also watching really closely, is what happens to our electric grid as well as other electricity generating opportunities, because that is an area that is going to be absolutely necessary to be able to facilitate the massive amount of compute that we expect will be needed in order to facilitate this revolution. And so with that, we'll open things up for questions.
All right, so the first question from Jim, a humorous one. I don't think, well, anyway, so here's a question. So is that really you guys talking, or is it a whole presentation AI? And I would say it really is us this time, but maybe not in the future. Second question, are you saying monopolies are good? I thought that was a bad thing for the economy. Can you expound upon that? Max, would you take that one, please?
Sure. It's a really good question. I think growing up in all of our training, we have all been taught that competition is a really good thing. And that's the heart of capitalism, right? Supply and demand and people competing, and it ultimately leads to things being better for society. And I think at a philosophical level, that's very true. But there is this interesting tension in capitalism between kind of the philosophy of capitalism and ultimately what business owners and investors want to achieve. So if you're looking to invest in a company, you want to find a company that is going to dominate. I mean, that's ultimately what we want, right? If we're investing our money, we want a company that is going to be able to effectively outwork and out innovate all of the competitors and ultimately gain a dominance in the space in which it operates. Now, what we don't want to have is companies that are doing things that are illegal or malicious in such a way that it's just unfair. But what we ultimately want to do is find industries and companies that have the ability, or just the nature of their industry is such that maybe they have some intellectual property. IP is the word that I was thinking of, that nobody else has. And it's going to take a really long time for other people to develop it, or maybe there are really high barriers to entry to getting into that industry. There are great, those are the types of investment opportunities that you want to look for. All of us know Warren Buffett, truly one of the best investors of all time. And that is specifically what he says he looks for as well. He's looking for companies that ultimately have the potential to become monopolies, that drive out competition because they're so strong and so effective. That's where you get the most profits. And so while when you look at maybe the nature of capitalism as a whole, monopolies do eliminate competition, it's really good from an investment standpoint. And that's why there's this interesting tension. And there's a lot of debate right now, truthfully, right now going on about whether these big monopolies like we're seeing with Google or with Apple or with Amazon are really good, and whether or not they should be broken up. And that's a debate that's going to be continued to be had going forward. And I'm sure the government's going to get involved at some point. But for the time being and going forward, we want to find those companies that ultimately become the next Apples, Googles, Amazons, because that's where a lot of the profits are ultimately found.
Thanks, Max. Next question. How will this innovation affect jobs going forward? Josh, would you take that one, please?
Sure, Bill. So one of the most common, I believe, fallacies that are believed is that innovation and the creation of technological efficiency results in jobs being lost. And while I believe that is technically accurate in the short term, it is not accurate in the long term. And we've seen that historically. Great example. Think about the invention of the automobile. Most people don't realize this, but one of the major reasons that automobiles became more popularized, as an example, like in the city of New York, was originally not because it was able to get you around faster, but simply because the streets of New York were filled with horse crap. And it literally took massive amounts of workers to clean it up every day. So the city started to implement and transition to automobiles simply so that they wouldn't have to deal with that anymore. Cars, while they have ultimately decimated industries like those who made saddles and horseshoes and people who did other specialized services for horses, did it ultimately destroy the economy and everybody go into a recession because people lost their jobs? The answer was no. Now, for those who were displaced in the short term, it is challenging, and it requires those individuals to innovate and try to be retrained into doing other things. And I sympathize for the challenges that can pose. But in that example, what happened? You ultimately saw entire new industries and new jobs built around the new series of innovation. And I would argue that the same thing will ultimately happen here as well. Take as an example the legal profession. If artificial intelligence can be used to help with the drafting of legal documents, sure, that can and probably will make legal firms, at least initially, more profitable. But what's most likely going to happen is that will probably drive down the cost of legal work because lawyers can do more with a smaller amount of time. And what is that likely to do? That will likely allow lawyers to be able to handle additional projects that might not otherwise have been feasible otherwise when legal work was a lot more expensive. There's a general principle in economics that the more expensive the price of something is, the less we use it. A great example, over the last 60 years, air travel in this country, the expense has dropped about 90% over the last 60 years. Guess what's also happened to the frequency of use of air travel? It's gone up 1,000%. And so that's what I would argue is that as we see innovation in each of these respective areas, what we're likely to see is people use them more frequently. And as a result, entire new industries and jobs will develop out of that innovation that ultimately takes place.
All right, thank you. Next question. You mentioned AI's impact on the electric grid. It also consumes large computing power, bandwidth, consulting, et cetera. Do you think there are investment opportunities for companies that provide products, services to the AI industry? Who would like to take that one?
I could take it. So yes, the answer is absolutely yes. In the same way, like with the gold mining era, people made money on picks and shovels. People who fund areas like infrastructure, there is money to be made. NVIDIA, AMD, other companies that are doing the chips are great examples of that. Now, how good of an investment are they today? That's a whole nother question entirely. But another good example, and we actually have seen this with a number of real estate companies. A lot of real estate companies are building data centers. Anytime you have a substantial imbalance or a high increase of demand and it's harder to build supply, those can create opportunities. But once again, you still have to evaluate basic fundamental principles. What is the price that you pay? How long does it take for you to develop it? How long will it take for you to recoup your initial investment? All of these types of principles are similar. And to be frank, this is where we're largely focusing our effort. Right now, when it comes to AI, we are largely focusing on, within the investments we make, on the infrastructure side of things. It's the lowest risk and it's the most easy area to understand, and you can really de-risk a lot of the investing that you choose to do. There's still obviously risk there, but there's a lot less unknowns in these areas.
All right, thank you. Well, those are all the questions that we have today. Thank you to our presenters, Josh, Max, and Laura. Have a great rest of the week, and we look forward to seeing you at our next Beyond the Noise webinar.